Are investors counting on too much from the Fed next year?
That's a great question. I think the answer is yes. But you know what, Tyler? I would have said that 20% ago or so in the S&P 500, and that would have been incorrect. The market is now up in 16% in 36 trading days, which is remarkable. We can talk about the move from lows to highs in the Russell. But what I look at, and I know Tim is probably looking at the same thing, relative strength index RSI is now north of 81. The last time it was this high was probably September of 2020, and that didn't augur particularly well for the market at that time. It doesn't mean the market's going down in a straight line, but it does mean in terms of sentiment, we are very overbought in levels we haven't seen in the last 3 or so years.
You know, it's interesting, Tyler. If I go back to late 2021, the last time the Fed signaled a pivot, right? They had late November said they were going to start raising interest rates in the new year to combat inflation, right? Well, here we are. We're in December of 2023. The stock market, as Guy just said, has rallied 16% off of those lows in late October. I go back to 2021, again, that December, the stock market rallied 7.5%. The S&P made a new high, I think, on the second trading day of the year in 2022, in the face of the Fed and what they were going to do. So you asked the question, are investors pricing in too much? You know, like, I understand what I think is going to come back as a pullback, because I think ultimately when the Fed cuts, it's not going to be for those great reasons that a lot of people are imputing right now into the markets. But, you know, sometimes markets have a way of doing things that you don't expect them. That's why I bring back to 2 years ago and the reaction here. Right now, it feels like there is no end in sight to how far stocks can rally. We're going to have a headline probably in the not so distant future, new all-time highs for the S&P 500. Your question, though, what do you do right there? Do you chase it? I'm not sure if you do that up 17, 18% in a straight line.
Yeah, it's a tough question. I mean, I feel like what's happening right now is just a chase, because many managers are behind whatever their benchmark might be. And so they feel like, all right, I have to be invested. And it's not about where things are trading or whether we're going to be in a recession, any of that. It's just, how do I show at the end of the year what, performance? And so this is sort of I don't know what kind of top it is, but it's some sort of top. But I don't know what to do about things. It's funny, when your own stock's up like 18% in a short amount of time, you feel like, all right, well, that makes sense. Yeah. When the other stocks that you don't own, you feel like, wow, this is really getting ahead of itself. Yeah. Right. So there's some of both going on here. But I think, I always say, if you went home long, it's as if you bought it at the close. So I essentially bought everything at the close here. And I'm going to hang on to it for a while. I think that the Fed put is sort of in. I don't know that it's an at-the-money put, right? It could be that the recession happens, we go down, and then the Fed's there. But for the moment, I'm staying long. The one thing I do really like, though, is the broadening out of the rally, right? We've been talking for a while about the Russell 2000. Exactly. I mean, today, a big outperformance by the Russell 2000. I like that. That looks healthy to me. Some of this, literally some charts that are straight up, that looks less healthy.
Yeah, Russell 2000 at levels not since August of 2022. The NASDAQ 100, I think, an all-time high. Tim, is it time for small caps? If you haven't gotten in, is there still good bargains there?
Well, I don't know about bargains, but it's certainly about time. I mean, small caps have underperformed for so long, and it's been such a significant underperformance that they were kind of due. I fit somewhere in the middle of the comments so far, meaning I can look at the broadening of the market and say this is great. I'm also very happy to see the relative strength of the leadership also continue. And let's be clear. I mean, NASDAQ's all-time highs. We're about to get there on the S&P, but the leadership that's coming from the semiconductor space and the mega cap stocks is what I think you actually need. So the combination of both of them, I think, is great news for markets. Back to the Fed, we hit 399 on December Fed fund futures. That's 135 basis points, 140 basis points, 150 basis points away. If the Fed does that next year in terms of cuts, something bad is going to happen, I think. Based upon the economy we have today, which is one that's reasonably strong, a labor market that's reasonably close to all-time lows in unemployment, where we know what's going on in manufacturing and leading indicators, not great, but there's other parts of the economy that are doing quite well. So this week to me and last week, but we had Savita from Bank of America on last night. Some of the keys to me is that the street and both the analyst community, but I think investors are getting comfortable with earnings growth in 24. And that's what you have to hang your hat on. I'm not saying we're going to get the 11 or 12% earnings growth that's forecasted, but that's the part of this that you need. And that's the part of this that after 3 quarters of an earnings recession, I think is where markets have to believe in 24.